This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
AI has taken over the markets as a precursor to it taking over the economy. Today we'll look to see if it can predict 100-year floods, if there's still room to invest in it, and what's the value proposition as we near the second half of 2024. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the portfolio managers here on the team. And let's get right down into it right now as I take you into the summer and Memorial Day weekend. Hopefully you're not actually listening to this during Memorial Day weekend. Get out there. I hope the sun is shining by the time this is produced. But the market, the S&P 500, it's up over 10% for the year as I step into the studio, albeit a bit below its recent all-time highs. In fact, what we've been seeing lately is narrower and narrower leadership in the markets. In the fourth quarter last year, you might remember we had that drawdown. The markets took over. We had this pullback in September and October, kind of a mini correction. And as the markets then started taking off in November, I was celebrating this broader rally. We had wide support for the markets. Most sectors, I'll say most names statistically, were doing well. And now it's the opposite, which all the investment cash seems to be piling into the hot names, maybe the Mag 7, maybe some of the ancillary other names with the hot AI tags on them. And the rest of the world is doing mediocre at best, albeit with actually pretty attractive earnings in many cases. Earnings that widely eclipsed very reduced expectations. And, this is all reflected in a 7 to 8% spread between the S&P 500 and that equal weight version of that index. And why not? When from 10,000 feet, it looks like it's a bad time to be adding equity exposure, frankly. The economy isn't growing very quickly. We're probably not getting those rate cuts that we had been expected. And mortgage rates are now ticking a bit higher again. The housing market is stalling. We actually had existing home sales and new home sales a little bit disappointing this last week. And every conversation seems to evolve the election. Now, there are innumerous collections of data out there, various ways of showing it, all correct, that show that elections really don't ultimately have a major impact on the markets, and certainly not on corporate earnings. Call Greg over here at the team and ask to see his slide on, I think it's a 50-year performance difference between if you had invested only during when your particular party is in power, or if when you stay invested, and if you stay invested for when each party controls the White House and Congress and what have you. And if you're at all engaged, and I promise you, if you've been engaged in these issues at all, you've been unhappy at various points over the last 20 years with current leadership. But if you used any of those times to let it affect your allocation and investment decisions, then you've made a poor move. Because the markets have continued to move higher through all of these administrations. I don't have a statistical proof of this. I don't know how far back we would have to go to find an administration that had a net loss in the markets. Quite a ways. I'll have to check because I don't think the aggregate years of Carter's administration had a negative, but that might be it. I know since then we haven't. Anyway, worry about your communities, worry about the world around you, but don't project your worries as this applies to the election onto the markets. And that being said, it's on everybody's mind, though, and along with a slew of other troubling headlines, cash is flowing into the names that make people feel good. They make you feel good that you're making the right decision, you're investing in something that's going to be cutting edge and change the world for decades to come. Anything that has that label involving AI on it. True story, even my golf clubs now say AI on them. I'm not sure why, but they're there. But they're also these AI companies, maybe not the golf clubs, but the real AI players are delivering transformative growth. Just be careful with your understanding of that company's particular sustainability the barriers to entry into what they're doing and what that company's competitive advantages in the field might be before chasing the hottest names out there. Even copper has gotten into this game, as it's had a massive run-up this year. Not supposedly because the Chinese economy and the rest of Asia is picking up demand for copper as their economies start to get some growth going. But according to a Wall Street Journal article on Thursday, copper has actually, according to them, been driven up by speculators who are looking just for another tertiary angle to invest in AI. And this is based upon all the demand for all the new wiring that's going to be needed. We've already had the talk of the land being the demand for electricity and producing more and more electricity. But now it's, how much wiring is going to be needed to carry all this electricity? That and every other angle regarding AI. That apparently is what driven up this most important of commodities in some respects, or it's up there at least, up 25% so far this year, albeit down now 5% from a recent high of just a few days ago. But I digress and I take a step back because, as I was saying, we had this nice broad-based market rally at the end of last year, and I had a podcast in December which featured kind of the annual forward outlooks for both JP Morgan and Goldman Sachs. And I was contrasting the two, which saw things very differently for this year. Goldman actually was estimating for 8 interest rate cuts this year. And JP Morgan was cautious that we might ultimately be disappointed and get very few, if any, rate cuts. And now, knowing what we know now, I'm going to update you all on the latest then from those same people over at JP Morgan, who said in a recent report this week that their, quote, negative stance on equities has hurt the performance on our multi-asset portfolio over the past year, though this has been in part compensated by an overweight in commodities and high cash and fixed income yields. However, with the very high equity valuations, as well as tight credit spreads and low levels of volatility, we do not see equities as attractive investments at the moment, and we don't see a reason to change our stance, end quote. Basically, outside of the AI boom, which is going to unfold over the course of many years and ultimately involve companies that really probably haven't even been conceived of yet, but it's all being priced in by the markets right now. And outside of that, the markets have been, I don't know if this is the right adjective, but stagnating a bit, but for good reason. And the overall data isn't suggesting that growth is very compelling right now, nor are valuations relative to this landscape very enticing. According to FactSet's Earnings Insight report, the forward 12-month PE on the S&P is now about 21 times earnings, which is well above the 5 and 10-year averages. And that number is pumped up because the S&P itself is concentrated in these big tech names, and those tech names are very cash rich. They're generating a lot of cash, and they are seeing strong earnings growth. So, there's kind of a justification for that. So I am not screaming the sky is falling here, but nonetheless, it ain't cheap. And per a morning report I received this week, quote, the path of least resistance for stocks has been higher, end quote. I guess that was at least until Thursday. But going on, continue with the quote, as markets traded with bad news is good news tilt, which hasn't provided for expectations for rate cuts, which the market now is pricing in less than half a point this year, end quote. In fact, I think the surprise that could maybe give us a boost, and I do mean surprise, this isn't therefore kind of our baseline model, but something that, we don't think about. Now, what could happen and get the market really going is maybe we will get rate cuts, and we actually do get them this summer. That would now be the surprise. And it's that unlikely at this point, with one Fed governor this past week saying that there's just not enough data now. There's not enough data release points now for the rest of the year to convince him that they've reached a point to justify a cut. So if we do get one, well, we've largely priced it out. So maybe we've swung too far the other way. I mean, I guess I could be contrarian for the sake of being contrarian here. And, I was downplaying the justification for cuts at the beginning of the year. Now, again, I'll just swing to the other side of the spectrum and say we can hope to see 1 or 2 this summer. But that's basically tongue-in-cheek. maybe we'll get lucky, but let's not depend on it. It'll be a bunch of conjecture for now because we really don't have a lot of information for the next couple of weeks. The next real major data point on monetary policy, at least, is that we get a CPI report that comes out on June 12th. So I reflect back on that JP Morgan Global Asset Allocation report from this week, whereby they, quote, maintain a defensive tilt on our model portfolio, end quote. And I look at recent history and, they're definitely not always right. They're not, the gospel here. And Goldman, as I often try to contrast the two against each other, Goldman, although they are known as commonly as the kind of very bullish name on the street, but they're often right and worth reading. But at a time like this, I reflect on JPM's recent calls that they've been more on point over recent history. And I'm going to talk about them as a company, as a bank a bit after the break. I'm not sure how deep I'll get into that, and I'll give a really quick disclaimer here. I'll do it again later. We own JP Morgan. I own JP Morgan. I'm talking about their analysis right now, but it is a stock that I favor and I have a conflict of interest in owning it. But I think about this and them being more conservative generally with their analysis, and I'm left with what's the harm today in following their lead right now? What's the risk and the harm in being too conservative today? They're calling to be underweight equities and overweight commodities and cash, and I wouldn't take that and reduce your equity holdings by 20 or 30%. Don't go out there and sell a third of your portfolio. But if you got cash working for you at 5% or so today, don't be in a rush to go cram it into the market and hope for a big spread over that 5%. Don't let the fear of missing out when you see certain stocks out there talked about by the person who's cutting your hair or driving your Uber ride or whatever. That's not a great sign for where your money should be going right now. No disrespect meant to hairdressers out there. Something else I read recently, which meshes with this, was the quarterly, I'm not sure if it was the quarterly or a monthly update from Howard Marks over at Oaktree. He runs Oaktree Capital. And he wrote a nice piece on debt and leverage, and he was citing other writers and pundits who talk about the risks of debt. And it's worth looking up. And if you want to look it up, you can go on the internet and look for the name of the piece was The Impact of Debt, not a great title, add Howard Marks' name or Oaktree, and you'll find it. And this is important to think about right now, not because this is a time in history where leverage is so great, at least not for big corporations, but we need to think about the consequences of the cost of it, even at relatively sustainable levels relative to sales or earnings or to equity. But we need to think about what the consequences are going to be when the debt starts to come due. Debt that was bought at or borrowed at much, much lower rates and now is coming due at substantially higher rates and then has to be replaced at substantially higher costs. I am going to take a quick break here, but when I come back, more on that, more on JP Morgan for the Wise Investor Show. I'll be back with that in a moment.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. I'm Simon Hamilton, Managing Director and Portfolio Manager with the Wise Investor Group of Raymond James. Every week we discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from sound portfolio management and how to become a better informed wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. When I stepped away, I was talking about Howard Marks and his thoughts on the risks of debt. And none of us are saying that we're opposed to having debt. Most corporations have some level of debt. Most households have some level of debt. But this piece of his was a warning sign against the complacency that grows and allows leverage to get out of hand, really the longer that one goes from the last time they learned a hard lesson. The cliche he used, and I often preach against the use of cliches when it comes to investing, but this one I enjoyed. He wrote that, quote, "The most important adage regarding leverage reminds us to never forget the 6-foot-tall person who drowned crossing a stream that was 5 feet deep on average." And he goes on to say, generally speaking, normal levels of volatility, those seen on a regular basis and documented through historical statistics, are used in investors' calculations and reflected in the amounts of leverage they employ. It's the isolated tail events that saddle levered investors with greatest losses, end quote. It actually reminds me, it's not a perfect analogy, but a clip I always throw in our Twitter feed once every few years of Sir John Templeton on the Louis Rukeyser show back in the crash of '87, and talking about how calm he was because he wasn't levered, he wasn't margined, and he wasn't worried about his investments. He was trying to use a market crash as an opportunity because his losses weren't unsustainable, or they were sustainable. I don't know. He was in good shape. This reminds me of that. So the debt's not a problem when you look at a balance sheet and you look at conservative projections. You take the debt, you say, well, it's not a lot of debt, and if we're projecting normal sales and what we expect the sales growth to be, and we'll discount that. You discount for normal volatility, but too many, if not most, just don't model for what I too will call tail events. And I like using that term because we don't want to say, hey, model for, the black swan, model for Armageddon. We don't model for Armageddon. We want to model for tail events. If the world comes to an end, none of this matters. If modern society is in such ruins that we're living in a new Mad Max-style reality, then, your gold bars are probably not going to save you from the ravaging hordes on the streets. But we should think about leverage as well beyond a few normal standard deviations of volatility. Ensure that, let's say, companies can withstand extended periods of extreme stress. And today, we see a lot of reports and, frankly, listen to a lot of conference calls where companies, in some cases, are either proud of leveraging up their sales so that they are garnering, therefore, greater earnings. And in other cases, some companies are shyly forced to defend the drag that their elevated cash holdings are having on earnings. And thankfully today, that's kind of flipped on its head a bit because big corporations are reaping pretty substantial interest income on those that have a lot of cash. But modeling versus normal periods of volatility allows the firm to move along in a generally predictable and profitable way, more so than it would have been without the leverage. However, it's not defended against the events that come every maybe 15 or 20 years or so. It's like in Japan where they built a series of nuclear power plants with backup diesel generators, and the generators were positioned high enough to withstand normal flooding, even excessive flooding. But it didn't protect against a 1 in 100-year flood like occurs after a major tsunami. And that led to a terrible, terrible meltdown in Fukushima, the costs which will never be fully appreciated or understood. And when you're dealing with nukes, you have to model for the worst-case scenario. Every other aspect of your portfolio, you can't model against the end of mankind, but you want to own or owe companies, if you owe their debt, who are built to persist against a tsunami that occurs every so often, even if you don't actually endure it. Marx goes on to say in his report, quote, "The problem is that extreme volatility and loss surface only infrequently. And as time passes without that happening, it appears more and more likely that it'll never happen. That assumptions regarding risk were too conservative," end quote. And it's not that a tsunami is statistically more likely every day that passes since the last one, but each passing day, it does convince too many that their risk models, which included it, are too conservative, and they begin to lower their guard, and that continues to happen over time. When there are times whereby returns are far greater than the range of the normal, we don't react much, and some average that into their norms, and so that it becomes more expected. They might look at a period of elevated returns and use it to even add more exposure to risk. Again, think about what's happening with the AI trends on the market now. It seems like it's unstoppable, right? However, the average band of returns is what it is. And the above average periods, they're nice to enjoy, but you must, by design, be prepared to weather the periods far below the averages and not be leveraged to a model that has strict boundaries such that a dip below the normal guardrails is going to do permanent lasting damage to you. Similarly, I saw this in a very dramatic fashion, unfortunately, in the early period of 2020 when we had that thankfully very brief but extremely violent drawdown in the markets as the pandemic really started to take hold. And those that then modeled that this was like the new normal and took aggressive, quick actions, panicked, even though they were situated and allocated responsibly going into that. Still, now they took what was a well-balanced, well-thought-out allocation, and they did permanent damage by reallocating to the tsunami as if the flood would never recede and we would be permanently living in Waterworld now. Marx goes on and says, quote, "Attitudes that govern the use of debt capital are examples of this cyclical process. When things have been going well for a while, asset prices have been rising, investment returns have been positive, and the use of leverage has paid off in the form of higher returns. Investors view leverage as benign. But what's particularly insidious with this angle on the cycle is not that a tsunami is coming. No, it's not like those that roiled the markets in 2020 or 2008 or 1999, et cetera, but it's that this wave of debt that's coming due that has to be dealt with. So I'm not calling for I'm never calling for a tail event to happen. You can't by definition predict them. But what I do, comfortable saying at least do see, is that there's a lot of debt. There's always debt coming due. That's the nature of it. You buy companies, banks, every major corporation has debt that has an expiration date, and you have to refinance it when it comes due. Sometimes they pay it down, and sometimes they add more onto it. But those that can't pay it down, those that have to continue to just issue new bonds when your bonds come due, well, if those bonds are going to cost you 4 or 5% more in yield, that's going to have a major impact on earnings. JP Morgan, going back to them, they're an example of a bank, and it's not a bank that has, they're not a bank that has no debt, but it's an example of a bank that has long-term had an emphasis on a fortress-like balance sheet, and it's weathered the storms and profited off of those that didn't prepare. And last year is a great example where they did far, far better than the banking index and their peers because they were a taker when many other banks were suffering as we got some bank failures last year. And again, we own JP Morgan stock. I own JP Morgan stock. So, beware that I'm particularly enamored with them and have this conflict of interest here. And they're not without, risks or fleas. They're a big global bank. But beyond banks, and in general, the banks are now, generally speaking, they're well situated because they have very high capital requirements. But there are many other companies out there that have effectively used leverage to expand their net margins and multiply their revenues into substantially higher earnings. And it's debt, in many cases, that can be managed and covered. But there are many cases out there where this debt is going to be coming due, and then the rate on it will be floating over the next few years. And for most of it, it won't be a meltdown. It's not going to make the companies insolvent, but it's going to reverse a lot of that multiplying effect on the earnings. And if you're buying a company today let's say 20 times earnings, right? That's what the market's at. So you're paying forward for some strong earnings growth. And now this starts impacting that average PE of 20. And that multiple starts rocketing higher because the earnings are actually, for the same sales, the earnings are going to go down because the cost of capital is much higher. That's going to be a problem. In the end, it's important for consumers and the housing industry and various reasons that will be benefited from lower interest rates, but it's the ability for large firms, large manufacturing companies, real estate companies, utilities, telecom, media companies, many other areas, it's their need to manage their balance sheets that really is going to be very important when we start thinking about where the market's going to be in 2, 3, 5 years and what this effect's going to have. This really isn't a story about telling you to manage your exposure to risk, not directly at least, but recognize that there are a lot of costs coming, starting to show up already, and the longer that rates linger here, higher for longer, as they're saying, the more impact it's going to have in the future on total earnings, on the economy, and ultimately on the value of these assets. The worst of it, well, that's going to really beat up one of the largest companies the most. Not the big tech names, which generally don't carry very much debt. But recently, the interest on the debt of the United States, the national debt, became a bigger cost than the defense budget. And the more that debt increases and the higher interest that's needed to be paid to cover it, the more that margins are going to be squeezed there as well. And that's just something I'm really not going to get deep into on this podcast. But for Memorial Day weekend, that's a nice lasting thought. As always, I do appreciate you listening in. I hope you have a wonderful holiday, and let's look forward to a great summer. And as always, thanks for tuning into the Wise Investor Show. For the Wise Investor Show, this is Chase Hinderstein.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.